how real estate investors can write off everyday expenses. Real estate investing isn't just about making money, it's also about keeping more of your money. And today I'm showing you how savvy investors legally write off everyday expenses to slash their tax bill. And stick around because I'm also going to answer some common tax questions from real estate investors at the end of this video. You know, most real estate investors don't realize that the tax code actually favors business owners. W-2 employees get limited deductions, but as investors, you are actually a business owner in the eyes of the IRS. And this is true even if you own rentals in your personal name. You don't have to have an LLC to take advantage of any of these write-offs that I'm going to be discussing today. Effectively, the IRS allows you to deduct anything that is ordinary and necessary with respect to your real estate business. So the key here is that you are actively engaged in real estate investing and using these expenses in the pursuit of your real estate business income. Now let's start off with the most commonly missed one, which is the home office deduction. If you manage your properties, analyze deals, or run a short-term rental loophole, you may qualify for the home office deduction. The home office deduction is an area in your home that's used specifically for real estate. Now it doesn't have to be a separate room. It could be part of a room or part of a house or even part of an ADU. And contrary to popular belief, claiming a home office is not an audit flag. It hasn't been for a long time. But let's go over an example. Let's say you're someone who is a flipper or landlord and you have an office in your home where you manage your rental properties. Well, now you can deduct a portion of your mortgage interest, property taxes, utilities, internet, and maybe even home security. There's two different ways to do it. You can use the simplified method, which is $5 per square foot, to calculate how much you can write off, or you can use the actual method. And the good thing about that is you can choose one of the two, depending on which gives you the most benefit. Another commonly missed tax deduction for real estate investors is car expenses. If you drive to check on your rentals or meet with a realtor, go to the bank, or go to a real estate event, those are potentially tax deductible business expenses for your cars. Now for vehicle, we typically have two options: the standard mileage, which right now is 70 cents per mile, or the actual expense method where you can write off the business portion of gas, maintenance, insurance, and even depreciation. So let's go over an example. Let's say an investor drove 10,000 business miles for last year. Well, they could potentially write off $7,000 in car deductions. All right, the other one not to forget about is meals with business purposes. You can deduct up to 50% of meals related to business meetings with agents, contractors, property managers, partners, potential investors, or maybe even your spouse if it's strictly for real estate purposes. So for example, you take a contractor out to lunch to discuss a bird project, you can write off that meal as a business expense. Make sure to keep a good record of the date, location, business purpose, and who you were with in case you're ever audited. Now, another thing to make sure you track is travel expenses for real estate. Travel expenses could be deductible if they have legitimate business purpose, and that includes flights, hotels, Ubers, and even conference fees. Now, the key thing for travel is to make sure you have predetermined business purpose before leaving for the trip. So an example could be you are attending a real estate conference in Miami, then you can write off your flight, hotel, and meals as long as, again, you have predetermined business purpose for the trip. Now, here's the key thing to keep in mind. If you mix business with personal during your travel, only the business-related expenses are typically tax deductible. So make sure you do lots of business. All right, another one people forget a lot is just the different gadgets we have, phones, laptop, and different software. If you're using these things for your real estate business, let's face it, who doesn't, you can deduct the business portion of those as well. So let's say you're a real estate investor and you use your cell phone and about 70% of that is used for your real estate business. You can write off 70% of those cell phone related costs. Same for all the other gadgets that you're using. Real estate specific software like property management, MLS subscription, deal analysis tools, those are fully deductible. And of course, for the favorite write-offs for real estate investors, depreciation, right? It's like the ultimate tax hack. Real estate investors get built-in tax benefits through depreciation, which is basically a paper write-off. So let's say you are a short-term rental investor and you buy a property for $500,000. With accelerated depreciation, you can get potentially up to $120,000 in first-year depreciation. This is a paper loss that reduces the taxable income of your rental property. And if you're strategic enough, you might be able to use it to offset your W-2 and other income as well if you meet material participation. As you can see, the tax law is written to favor real estate investors. All you need to do is know how to take advantage of it. If you like what you heard, be sure to hit the like button and subscribe below for more real estate tax savings tips.